Earnings are back in the conversation, and this time corporate results for the second quarter of 2025. Let's get a read now on what we can expect from our research director, Shiraz Mian. Shiraz, we're in the early going yet, but is the earnings bar set low this Q2 as investors have to deal with slower earnings momentum and a lot of other macroeconomic issues?
So, Terry, the short answer is yes. What we saw in Q2 was that at the start of the period, we had the tariff announcements and a host of other uh, variables that created a lot of uncertainty for analysts, for investors, and for management teams, and which prompted analysts to really lower their estimates at a pace that was significantly higher than what we have used to seeing in recent quarters. So uh, the revision trend notably stabilized later in the quarter, but the net result of that earlier negative estimate revisions is that it has left us with an estimates level that I believe is on the lower side. So expectations are low, which should make it easier for these companies to jump through them.
Will the focus again be more on forward company guidance this time around?
Sure, yeah. So the important thing in the earnings releases always is the forward guidance, and I see no reason for that to be any different. Um, Given the multiple variables that I was referring to earlier, that increases the significance of how the second half of the year and next year shape up. So yes, to the extent management teams can give us explicit guidance, if not to qualitatively discuss what they see in terms of business trends, will be the key for how these stocks and the market as a whole react to the earnings results.
So, how much do you see tariff developments affecting guidance?
A ton. But we have to keep in mind not every sector, industry, and company is exposed to merchandise, international trade. Some sectors are a lot more exposed to the tariffs, the new tariffs, than others. So the consumer goods, electronics, staples, many discretionary items. It's a big deal for them, and it will have a big negative bearing on how businesses in those sectors will evolve in the coming days.
At the sector level, so far, the big banks and the brokers have reported. Now, they seem to be doing fine. Is that right?
Absolutely, in fact, better than fine, Terry. The What I was expecting was that, uh, contrary to what the expectation was at the beginning of the year, that by the second quarter we'll start seeing a lot more momentum in the economy and in particular in the banking sector. Things had turned out to be differently and in a negative sense for the finance sector. So I wasn't looking for any any fireworks or a lot of momentum and good developments from the space, but the actual results both for Q2 as well as for the guidance or even qualitative commentary has largely been positive.
You wrote recently that Q2 earnings estimates for 13 of the 16 ZAC sectors have come down since the quarter got underway, with aerospace, utilities, and consumer discretionary as the only sectors whose estimates have modestly moved higher since the start of April. What's the story there?
So So yes, as I noted earlier, at the start of the quarter in early April, because of the tariff announcements, and those have proved to be the worst case scenario. So estimates really got cut, and it appears they got cut more than needed to be. But these three sectors not only did not participate in that, but actually stayed in the opposite direction. And you would note aerospace, utilities, and discretionary. Um, though discretionary has some sub industries that are exposed to international merchandise trade, I'm referring to like the likes of Nike's, which is in the footwear apparel. Um, on the apparel side, you have like Lululemon and companies like that. And then like furniture and other appliance makers, which also fall in the discretionary. But keep in mind, we have the media houses, the News Corps, the Fox, the Disneys, the Netflixes. Those are also grouped within discretionary, and the outlook for that, the earnings outlook for the media industry has been positive. Utilities is benefiting from all of this AI centric ramp up in demand for electricity for the data centers. And aerospace is mostly a Boeing story, Terry. Boeing has been struggling for a while now, and they finally seem to have their house in order, and that's starting to show up in estimates for for the sector as a whole. So, other than these three, estimates for practically everyone else came down.
So you mentioned AI. I'm assuming technology is going to be another main focus this earnings season, since it is one of the main contributors to the aggregate S&P 500 earnings.
Absolutely. Technology is the largest earnings contributor to the index. It is also has the largest weightage in the market as a whole in the S&P 500 index. And then these mega cap tech companies, they have an outsized effect, both in terms of their earnings contribution and the market caps that these companies have. We recently, you may have seen headlines about Nvidia, the chip maker, crossing the 4 trillion market cap line. So yes, the earnings outlook for tech will be key to how the aggregate picture is interpreted. And I should note in there, Terry, that the earlier reference I made to the revision trend stabilizing as we went through uh, the halfway mark in Q2, the prominent contributor to that stabilization was technology. We saw that estimates for the tech sector not only stabilized, but for a number of the constituent tech sector industries actually started going up, including these mega cap tech companies. So the as we exited Q2, the momentum was very much on the positive side in an earnings sense, and we obviously know that was the case in the stock market as well. So a lot will be riding on how the earnings results from these companies turn out to be.
Energy recently has been a bit of a laggard. Do you see that sector recovering?
Uh, I've been I've been disappointed and also surprised, Terry, in the energy sector. As you know, I used to be in another incarnation, the energy sector analyst, and I was surprised how the underlying commodity behaved during the recent Middle East war. Under normal circumstances, you would have expected oil prices to be north of 100, and we didn't see that. So it's the earnings outlook for the sector is a function of the supply demand fundamentals of oil. And oil appears to be, the outlook for oil appears to be fairly weak. And as a result, the outlook for the sector, the earnings outlook for the sector is pretty weak.
What toll do you see tariffs taking on the actual corporate results for Q2?
So, net, it's negative. Turns out it's not as bad as everybody in the market assumed it will be at the beginning of Q2. But we should keep in mind that tariffs are a tax, and while not all of the tax is paid by U.S. consumers, it's a big chunk of it is borne by the importing company, and then some of it is borne by the exporter, the foreign maker of the product. So it's a hit to margins to the extent that it's a commoditized product, undifferentiated product. My sense would be that competing locally sourced product will force the importer to eat the hit to margin and not pass it on to consumers. But it will have an impact on margin, howsoever small. Keep in mind that about a year ago, the effective tariff rate for the U.S. economy was close to 3%. Now it's north of 10%. And most likely, when all is said and done, it will be in the 15 to 20% range. So it will have a negative impact on earnings. Hard to quantify at this stage, given we don't know what the final level of the effective tariff rate will be. But it's undoubtedly a lot less severe than what everybody started being fearful of at the beginning of April.
So, since we are in the early going of this second quarter earnings season here on July the 17th, 2025, can you put a number on growth when the dust all settles, or is it too early?
So yes, it is too early, Terry. We have had only 10% of S&P 500 companies reported results. Before the report started coming out, the expectation was for less than 5%. It has already improved to 6%. I would say by the time everything is said and done, it will be a lot higher than 6%, perhaps around 8.5%. But we'll have to see how sectors other than finance report results, and we get a sense of the magnitude of positive surprises in those numbers.
Well, that published data is showing right now that 5% or less growth, that would turn out to be the slowest profit growth since the end of 2023, right?
That's correct, yes. So if the final earnings growth rate for Q2 proves to be 5%, that will be the slowest growth rate since the third quarter of 2023, yes.
All right. We wanted to remind everyone that who is listening that you can follow Shiraz's commentary on Zacks.com. You can access it right off the homepage. He can give you all of his thoughts and developments on all the nuances for this Q2 earnings season right in their written commentary that you can access readily off of the homepage at Zacks.com. With Shiraz Mian, I'm Terry Ruffalo. Now here's something for you to check out. It's a free book, Finding Number One Stocks, a 300-page hardcover where Zacks Executive Vice President Kevin Matras reveals almost every stock-picking secret he's learned from the system that since 1988 has more than doubled the average yearly gain of the S&P 500. Learn more at Zacks.com/promo.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.